In this video, we will like to calculate this very important idea called GDP, Gross Domestic Product. And we also would like to touch upon the difference between what is known as nominal GDP and real GDP. So let's go about first understanding what is nominal GDP. So nominal GDP is GDP measured at current prices. And real GDP is GDP measured at constant prices. So understand GDP is the market value of all final goods and services produced in a country in a given period of time. And so one needs the market value which is given by the price. But the question really then becomes is which price should one use to value the products that we are producing, right? So in a nominal GDP, we use the current prices. In computing real GDP, you would use a constant price. So you don't allow prices to change when you look at the real GDP. And you'll understand in just a bit, quite straightforward, why is that the case. So let's take an example of two products. Let's produce those two products, apples and oranges. And we have the data for how much apples and oranges we produced and the price of those apples and oranges across 3 years, year 1, year 2, and year 3, right? And then let's compute nominal GDP. So when you produce 2000 apples and when each apple is 25 cents, the market value of apples, all the apples together, is $500. And when you produce 1000 oranges and when each orange is 50 cents, the market value of all the oranges together is $500 as well. But GDP is the aggregate of all final goods and services produced, right? So these are final goods and services produced, and the aggregate of the two, so or the sum total of the two, is what is the meaning of GDP, right? So 1000 is the GDP, and so you do the same operations in year 2. The apples are 30 cents and the oranges are 70 cents, and the market value of all final goods and services produced in this country, apples and oranges, is what we are producing. And the price that we're using is the current price, the price that was prevailing in year 2, 30 cents and 70 cents for apples and oranges respectively. Then you get the market value to be 1300. And same thing, you do the same operation for year 3 and you get 1500, right? And so that's what nominal GDP is. To value these apples and oranges in each of these years, we are using the price that is prevailing in that particular year. So the current prices or the price of that particular year. So that's how we are valuing these apples and oranges when you talk about nominal GDP. But this GDP is about production, right? And it's not too much about the prices alone. So when you talk about production, one should be looking at quantities. But you also cannot add 2000 plus 1000 because you are adding apples plus oranges. What do you mean by that? There's nothing called 3000. It's just 2000 apples and 1000 oranges. So you cannot add these two numbers. So you need the market value. But when you use the market value and you use the current price to represent this market value, you end up getting this picture that, okay, from year 1 to year 2, the production increased by $300. From year 2 to year 3, the production increased by another $200 of 1500, right? But if you ask a question to yourself, did the production increase from year 1 to year 2? Clearly, we are producing 2000 in year 1 and 1000 in year 1, and the same 2000 and 1000 in year 2. So we are not producing more, right? You can clearly see that the reason why this 1000 becomes 1300 is exclusively due to the prices and not due to the production. When you move from year 2 to year 3, you add another $200 in the total GDP. But the addition of this $200, we ask the question, are we producing more? And the answer is yes, you are producing 2000 and 1000 in year 2, but in year 3 you are producing 200 more of each, whereas the prices are not changed at all. And so this 200 is due to increase in production for sure, but this 300 is not increase in production, right? You're not producing more. So how does one get this real picture? Now notice the reason why this is happening is because you are using the current prices to value apples and oranges or things that we are producing. And so there is two effects that is going on in these aggregate numbers. One is the quantity effect, other is the price effect, right? So you have quantity and price effect, quantity and price effect. You're multiplying the two, and hence these numbers reflect both the forces. The change in these numbers happen due to two reasons: quantity or prices. But we don't want the effect of prices, so we keep prices constant for our computation. Prices do change in reality, but as far as computation is concerned, we kind of use the same prices that we used in year one. Year one, we are assuming is to be the base year. The base year is the year which you use the prices for all the years in forward. So in the base year, the prices of apples and oranges was 25 cents and 50 cents respectively, right? And you use the exact same numbers, same prices keep constant, to value the apples and oranges for all the years moving forward. So in all the years moving forward, we value every single apple at 25 cents and every single orange at 50 cents. And when you keep these prices constant, any change in the numbers will only happen due to quantities, right? Because prices are constant. So there is the change in numbers is not going to happen due to prices because prices are constant. And hence this is what we call the real GDP, which is basically inflation adjusted GDP. There is no effect of price changes, which is nothing but inflation. And so real GDP is nominal GDP adjusted for inflation, right? So when you adjust for inflation, when you account for inflation, you would end up getting real GDP. And so then rest is just a simple computation. 2000 times 25 and 1000 times 50 is 1000, right? Here the same numbers. So again 1000, and then this is 2200 multiplied by 25 cents, and then 1200 multiplied by 50 cents, which is 1150, right? Now notice how much is the change in production. How much more are we producing from year one to year two? Zero. There's no more we are producing. Well, yeah, I know that, right? We are producing exactly the same number of oranges and apples in both the years, in year one and year two. Between year two and year three, how much more are we producing? 200 each. And that is reflected by this $150 million or $1 billion or just whatever is the unit, 150 units, $150 of increase between year 2 and year 3. That's the real increase in production, hence the word real, right? So again, nominal GDP measured at current prices, real GDP measured at constant prices. And because you keep prices constant in measuring of real GDP, there is no inflation effect. In other words, it is inflation adjusted GDP, or when you adjust nominal GDP for inflation, you get what is known as real GDP. For all practical purposes, one would typically use this as a measure of production.